Good morning. It's Jeffrey Christian of CPM Group. It's about 5 minutes after 11 here in New York on Friday, the 11th of April. We've had quite a week in the world economy and political environment, and we've had quite a week in the precious metals markets. We're going to talk about very little about the state of the world. It's pretty obvious what's going on. We have seen over the last 2 days, yesterday and today, releases of the March U.S. Consumer Price Index and March Producer Price Index. I'll go through some of those statistics, and then we'll talk about the precious metals markets, some of the things that are happening in gold and in silver, platinum, and palladium. So this is the chart of our projections. The history is on the left side of that dotted line. That's actually what has happened over the course of the last 45 years in terms of economic activity measured in terms of real GDP. The red line is the world. The dark blue line on the bottom is the industrialized world, and the lighter blue line at the top are emerging and developing countries. And you can see that, we've had several recessions over that period of time: 1980, 1981, 82, 1991, 2001, relatively short and shallow recessions, those two. The big one in 2007 into 2009, and then the big one in 2020, and then a recovery in 2021, 2022. CPM Group's expectation is that there is going to be another recession probably within the next 24 months. All of the indications suggest that that's true. We had thought that it could occur as early as 2024, but 2024 was relatively decent economically. We did see weakening growth in the industrialized world, and we did see weakening growth in the developing economies as well. The storm clouds are gathering, and we think it's pretty probable that we'll see a relatively severe recession over the next couple years, given everything that's going on in the world. I won't bore you with all of that. And then the subsequent economic recovery and expansion, you'll see we have a much more anemic recovery beyond 2026 on a global basis. We think that world economic growth will not go back to where we saw it in the 1980s into 2019. It's a problem. I will say this is our current economic projections for the next 10 years. We're wrestling with updating them because we think that we should make it a more severe recession over the next couple of years. We had already booked in a severe recession, but given some of the economic and political developments that we've seen over the last 4 months or so, our expectation is that the recession could be worse and the economic recovery could be more anemic, although we already had a pretty pessimistic view. So we've been wrestling with that in our long-term economic outlook, which then flavors and conditions our long-term economic outlook for supply, demand, and prices that we do for gold, silver, platinum group metals, molybdenum, high-purity manganese, tantalum, niobium, tin, all of the LME 6 base metals, and hafnium and other specialty metals. Looking at the U.S. CPI and PPI, we've seen some weakness. And on a month-to-month basis, we actually had deflation on a total basis in March, negative 0.1% contraction in prices. So prices actually fell in total in March. Now, I put here the link where you can get this. You can get the Bureau of Labor Statistics monthly CPI document, and I'll show you and talk about that a little bit later. But one of the things that we are asked oftentimes is, where do you get good information as opposed to the biased garbage that you can get for free, either from the internet or from banks and brokerage houses? And one of the points that we always make is we go to the root source. We don't read or listen to people's analyses of various economic and political developments. We do listen to them somewhat, but we go to the root sources. So when all these douches were talking about how the BRICS was going to come out with their own currency and it was going to be gold backed, we went and got the BRICS communique after its October meeting, in which it did not mention currencies, it did not mention gold, and it mentioned that the purpose of BRICS is not to destroy or replace or compete with the existing world economic and monetary systems, but rather to reform them to be more representative of the state of the world. And the BRICS said, we want to see that centered. It makes the most sense to center that on a reformed International Monetary Fund. We go to the source. So we go to the source for CPI. We go to the source for PPI. We go to the source wherever we can, as well as listening to reasonable minds and people. We try to avoid demagogues, as I mentioned earlier in the week. And we'll talk more about this as time goes on. But one of the things we do is we go to the source. If you really want to know about the Consumer Price Index, go to the source. Go to the Bureau of Labor Statistics and read their report. I'll show it to you in a second if I can. But we did see this decline. But if you look at it, it was almost exclusively oil. Almost every other portion or segment of the Consumer Price Index was rising last month. Oil is not in the Consumer Price Index, but gasoline and heating oil are. They fell sharply. They dragged the total down. You can see that on the month-to-month chart. You can see the blue line are all items, and the red line is all items less food and energy. Food and energy are more volatile, so the Bureau of Labor Statistics looks at all items less food and energy to see what the broader economy is doing, excluding the more volatile food and energy prices. And you can see energy prices have been falling sharply over the last year. And they haven't been falling sharply. I'm sorry. They have been. Yeah, they have been. So if you include that in your all items figure, you've seen much lower inflation, going down to 2.4% year over year change last September, coming back up to 3%, and now back down to 2.4%. If you exclude the more volatile food and energy, you see that we have seen a decline. It did decline through most of last year. It reached a low really in July and August, and moved sideways into December, spiked up a little bit in January, bad weather, and has come down in February and March. But you can see that excluding food and energy, you have 3.1% in CPI ex food and energy in February, and 2.8% in March. So still pretty high, still above the Fed's target, but coming down. So there are deflationary and disinflationary pressures, even as there continue to be inflationary pressures. Now, I brought in this chart table, and I don't know if you can see it, but again, 2.4% on a total all items CPI of a 12-month basis, and 2.8% if you exclude food and energy. And then you can go through it, and if you look at the March data, which is month to month, you'll see that energy prices declined, and the big declines are 6.1% in gasoline and 6.3% in heating oil. Energy services also declined somewhat, I believe. So, no, they didn't. I'm sorry. I apologize. They were up 1.6%. So that was the big decline. If you look, virtually everything else rose. There were two declines. One was used cars and trucks at 0.7% decline, and the other one was medical goods, which declined as well, and transportation services. But you saw relatively broader consumer prices continuing to rise, but at a slower pace. Similarly with producer prices, and producer prices are sort of a leading indicator of consumer prices. That's why we look at them. They basically were all negative. You can look at the Bureau of Labor Statistics. And again, here's a URL where you can actually get the report and study it yourself and go through it. The producer prices declined across the board. They break it down into final demand, final demands for goods, and final demand for services. And you can see that the final demand for services have held up relatively higher than the demand for goods. Now, let me go back. As I said, I wanted to try this. That's right. This is the Bureau of Labor's statistics monthly CPI release that came out yesterday. And you can see at the top, it's 37 pages long. So when these guys tell you that the Bureau of Labor Statistics CPI index is not representative of overall prices, I doubt that most of those people have ever looked at this report. I know that when I've showed it to people in conferences, it's there. But let's just look. So you have the charts I use, the table I use, and you have discussions and analyses of them all for just a few pages. It's not that bad. This is a very important page, an explanation of what the CPI actually is and how it's calculated, collecting data from thousands of citizens around the country as to what they actually were buying and what they were actually paying for it. So all this jibe talk about the CPI not being representative. CPI is a survey. It's not a census. They don't measure what everybody in the United States bought and what they paid for it. They take a representative survey of representative consumers across the country. And it's very important to understand because you'll hear all kinds of nonsense about what the CPI is. This is how they calculate it. You can read it yourself and you can say, gee, that guy's been lying to me all those years. And then it breaks down. Now I'm on to page 8 here and you start seeing table 1. Most of the rest of the report are tables. Here's page 9. Eggs, 5.9% increase in March after a 10.4%. So I guess egg prices, the rate of increases is slowing, but it's still 6% last month. So not so good. Anyway, this is a great source of actual data. And if you want to know what's actually going on, as opposed to listening to somebody who may or may not be full of garbage, nonsense, that's where you go. You can get the PPI here. Here's the PPI data from the PPI release, and you can go across the bottom, which is March. You'll see a negative 0.4% contraction or reduction in producer price index. And then you can break it down. The final demand, less the food and energy and trade, was 0.1%. So there still was some upward pressure. And then you can break it down. Final demand goods, 0.9% for the total, most of which was food and energy. Less the food and energy was actually up 0.3. So there's still inflationary pressures there. Final demand services, negative 0.2%. And then you can go through and see most of that was trade and transportation. Everything else was up 0.1%. Actual data calculated by actual economists and statisticians who don't have a bias and probably had nice parents. Let's turn to gold and silver and platinum and palladium. Gold prices have been on quite a wild ride. They got up to a record price over $3,200 last week. They came down to $2,970, I believe was the low this week. So a massive sell-off. And then they're back up. And yesterday, they got up to $3,195 during the COMEX trading. Once the COMEX reopened for its night trading, the price went up over 3,200. It went to a new record this morning of $3,256, $55.90, according to the CME screen. And right now it's trading about $3,246. So gold is at record levels. And if you want to know why, go back to that first chart I showed you that look at the state of the world, economically and politically. We're in really bad shape. And our expectation is that the gold price will continue to rise to new records over the course of this year and next year, possibly into 2027, because the problems that we're looking at are going to get worse. They're not going to get better. The House of Representatives yesterday agreed with the Senate's bill, which was structured based on what the White House wants. It will add $580 billion a year to the annual deficits. It will double the rate of increase in federal debt. It will give massive tax breaks to corporations and wealthy people. And it will slash payments to middle class and lower class people, lower income people who need those government supports that they've relied on since the Great Depression. So pretty bad. And then you have the tariff stuff and you have other things. We keep telling our clients the tariff information is bad, and it's bad for the world. It's bad for the United States. It's going to cause major problems on a long-term as well as short-term basis. But the tariffs alone are not the only problem. You have all sorts of other policies being put in place in the United States and in other countries that all have a cumulative negative effect on economic growth and the dispersion of economic well-being across the spectrum of individuals. So that golden renaissance of higher investment demand that we first predicted in November of 2000 is going to continue for the foreseeable future. We see gold prices, I'll tell you, if we saw gold prices 10% higher than they are now on an annual average basis over the next 2 or 3 years, that's an enormous increase. We wouldn't be surprised. But we also wouldn't be surprised to see the kind of volatility that we've seen over the last week or two continuing. So the idea of a $200 or a $300 swing in the gold price over the course of a week can't be ruled out over the next month or so for sure. Now, how does that show up in our trade recommendations? This was the trade recommendation we did last Thursday, April 3rd. And normally we have, you can see at the bottom, a stop loss. But last Thursday, we said no stop loss. We try to continually improve on these things so that they get closer and closer to the way that CPM Group actually thinks about short-term investments and puts in place short-term investments for our clients. We do manage assets, and we don't manage assets the way these things do. We tend to be medium-term and longer-term investors as opposed to ultra short-term investors. So we're trying to bring these things we're constantly trying to bring our ultra short-term trade recommendations closer to the way we actually trade precious metals for our clients. So our recommendation a week ago was stand aside, stay long if you're long. The price was $3,129 as we wrote this on April 3rd. Stay long, don't sell your metal, stand aside, don't buy at this level necessarily, but be prepared to buy on dips. Then we gave a target range of $3,050, which was $79 less than the price when we were writing. And a target price of $3,195, which was, what, $60, $70 higher. The price blew past that 3,000. We suspended the idea of having a stop loss because we just thought that the volatility would be so great. And we were saying, be prepared to buy on dips. The price ultimately blew past 3,050 on the downside and got down to, as I said, to 2,900 and some odd dollars. It was about $70 below our range, the bottom of our range. Hopefully our investor clients listened to that and bought, because then the price rose, and the price has risen, sharply over the last 2.5 days, up to record levels of $3,246. We will be coming out with it. You can see that the time frame was through today, April 11th. We'll be coming out with a new gold trade recommendation, as well as silver, platinum, and palladium trade recommendations on these ultra short-term trade recommendations. We'll be coming out with those later today after we get this video done. But that's where we are with gold. We're looking at a price that's going to continue to rise and is going to continue to be extremely volatile. Turning to silver, silver hasn't done as well as gold. Now, this is some data on the COMEX silver. May is an active contract. We saw big liquidation of COMEX positions in silver over the last 2 days. It's something that's unusual. The top line shows you the May open interest, which has gone from 618 million ounces, 619 million ounces at the end of March, 10, 11 days ago, to 400 million ounces as of Wednesday the 9th. Open interest in the July contract, the next active contract, has risen from 152 million ounces to 260 million ounces. So you've seen a progressive roll of contracts where the people who are short the May contract would buy back those shorts in May and go short in July, rolling their hedges, which is what most of those shorts are. Some of them are speculative, and that shows up in the data that's lower on this page, right? But those that are hedging are rolling into the July contract, and that's proceeding at pace. You can see at the bottom here, the roll since the beginning of April has been 108 million ounces have rolled from May into July. Other contracts were rolled into further down the calendar roll. Now, on the left-hand side, you'll see deliveries. And we measured gold because April is an active delivery month for gold. We'd seen this coming. We saw some of the rolls in March. So far in April, we've seen 6 million ounces delivered into the April COMEX contract. That was expected, and it's happening. It's larger than usual. Typically, you might see a 3 or a 4 million ounce delivery period in April, but it's more significant now this time. And most of that, probably 85% of it, was in the first 2 days of the delivery period. Interestingly, we've also seen 13 million ounces, 13.5 million ounces of silver delivered during April. April is not an active delivery month traditionally for silver, but we have a lot of investors who have been buying gold and silver and want it local New York. And we've seen 13 million ounces of deliveries in the silver contract. Now, you take that reduction, and I have 2 periods here. One is just the last 2 days, and the other one is since March 31st. You take that reduction, saw 130 million ounces of May open interest disappear over the last 2 days. The roll is about 29.5 million ounces. The deliveries, which are really month to date, I didn't bother to calculate that. I apologize. I could have. We have the data. The month to date deliveries are 13.5. which would imply that there was a closeout of about 87.8 million ounces. It's actually more than that because the deliveries are month to date, and I failed to make that calculation. I apologize. You had a massive amount of people who were short the COMEX that have liquidated over the last 2 days as the COMEX silver price declined. If you look at it over the course of the first 10 trading days or whatever it's been, well, through the 9th, it would have been 8 trading days. So about a 218 million ounce reduction in the May open interest. Of that, 108 million, a little bit more than half, I guess, or just about half of it, has been a roll into the July contract. You've got that 13.6 million ounces of deliveries, and that leaves a implied closeout of 97 million ounces. Now, of that 97 million ounces, 88 of it has occurred in the last 2 days. As the price of silver fell, the shorts were saying, okay, I can get out of this price. I can get out of this at prices $30 an ounce or lower, and they've simply closed out. And you also had longs closing out because, hey, I thought the price would be $50, or that guy in Vancouver told me the price would be $750 by now. So I'm getting $33. I don't think it's going to even make $35. I'm out. So you've had a big liquidation of open interest on the COMEX over the last 2 days. That's something to pay attention to because it suggests that the bulls are less bullish and the bears are less bearish. Here you can see the silver price, and you can see how it plunged over the last several days. And people were taking advantage of silver prices below $30, below $31. The price right now is $31.53 on the COMEX for the May contract. So silver's underperformed gold. And the reason is very obvious. More people look at gold as a financial asset, a safe haven, a hedge against the stock market declines, a hedge against the bond market declines, a hedge against currency volatility, inflation, economic and political unrest and uncertainty and risk. So more people have been buying gold than have been buying silver around the world. Our expectation is that the silver price will rise. Unfortunately, for our clients that pay attention to our short-term trade recommendations, whereas we suspended the stop loss on our gold trade recommendation last week, we had a stop loss on silver. So anybody who had put that in place would have been stopped out of the market. And we will be we had a buy recommendation on silver, and we continue to have a buy recommendation. And the reason is obvious. We still have 400 million ounces of open interest in the May contract that needs to be resolved, and most of that resolution will be between now and the end of April. Looking at platinum and palladium, platinum prices and palladium prices have both fallen. We thought that they would rise. You can see from these two charts, platinum price has really been trading between 800 and 1100 for most of the last 3 or 4 years. And our expectation is that it will continue to do that. Our expectation a week ago was that the platinum price might rise toward the high end of that, but instead it moved to the low end and it broke below $900 on an intraday basis a couple days ago. Our expectation is that that range basically will probably still hold for platinum. And similarly for palladium, although you can see here that from a longer term perspective, the palladium price had gotten to very high record levels over the period 2000-2022. It spiked very high. That spike is the day that Russia invaded Ukraine. And it's been downhill ever since that time. Well, no, it hasn't. It was downhill in 2022, 2023. In 2024, 2025, year to date, we've basically seen the price trading again, $900 on the low end and $1,100 on the high end. And our expectation is that that range will continue. That's all I have for today. You can go to our website and buy our gold yearbook, which came out in March. We'll be coming out with our silver yearbook in May. It will have accurate, honest, unbiased silver statistics. We will accurately report on supply, demand, above ground inventories, investment demand, what's going on in the exchanges. And then we'll come out with our Platinum Group yearbook later in the year. You can go to our website and read about our retail investor program and sign up for it. It's right here. It's a lower priced effort package of research services compared to some of the more expensive things that we do for corporations and institutional investors. You can go to our website, get free reads, free videos. You can send us an email at info@cpmgroup.com to ask us how we can help you better manage your exposure to precious metals and commodities. Take care. Have a good weekend. I will see you next week. Well, I won't see you, but you'll see me because we'll be doing another video on Tuesday. And let's see where the world is by next Tuesday, because every day is a soap opera now, and it's going to continue to be that way. Take care.